Welcome back. On Wednesday, March 21, African leaders gathered at an extraordinary summit of the African Union in Kigali, Rwanda, to sign an agreement which established the African Continental Free Trade Area, AfCTA. The decision to establish the free trade area, which is poised to be the world's largest free trade area in terms of participating members since the creation of the World Trade Organization, stems from the 18th ordinary session of the AU in 2012, where member nations agreed to establish the free trade area by 2017. However, Nigeria and 9 other countries refused to sign this agreement. Interestingly, Nigeria was absent at that meeting. Investment analysts at Afrinvest Securities in their report looked at various perspectives to this and highlighted the pains and the gains. I'm being joined by one of the analysts at Afrinvest, Valiance Moweta. Hello, Valiance. Good to have you on the show.
Good to be here.
All right, looking at the agreement signed in Kigali, give us a general background of this and what does this mean for business and trade in Africa?
Okay, so in 1991, the Abuja Treaty was signed, and it was signed to create the African Economic Community, and they were to do this in 6 stages over a 34-year period. So by 2012, like you said earlier, there was a meeting of African leaders, and they decided to create a free trade area by 2017. However, there was an extension, and by March 2018, it was signed into agreement. What this means for the African continent per se is it was done to boost intra-African trade. Intra-African trade is one of the lowest in the world. That's trade between countries on the African continent is one of the lowest in the world at about 16%, compared to regions in Asia which are at about 51%, and then Europe, which goes as high as 60–70% of trade within the continent. Africa is still at about 16%, while also contributing a little over 3% to the total trade volumes in the world. So this was actually done to boost trade within regions on the African continent, and as such, integrate businesses and also grow the African economy as a whole.
Now, looking at the whole scenario, would you say that the continent has actually put out some strategic plan, has enacted some strategic plan towards achieving this? Yes,
they have. So the initial plan, or it still is the plan, is to do this in 6 stages, like I said earlier, over a 34-year period. So the first stage was actually to integrate the existing RECs. RECs stand for Regional Economic Communities. So you have your ECOWAS, you have your EAC, the South African Development Community. So these are economic powerhouses made up by neighboring countries in different regions of the continent. And the first stage is actually to integrate them. So, okay, you have your ECOWAS and you have your South African Development Community. I'm using these as examples. How do you merge the both of them together? So, although we are not very close to each other, we have some form of trade agreement between our members. After that, the next stage was actually to normalize the tariffs. So, you're importing a product from, let's say, Europe into an ECOWAS nation. Is it going to be cheaper or more expensive to do that as opposed to importing it into an East African country? So the second stage was actually to normalize tariffs within these different regional economic communities. And then they move forward again to now saying, oh, how can we reduce or totally eliminate tariffs on African products? So you have made in Africa products that are going to find their way within different countries. So then they moved to actually, there's going to be a move to actually remove tariffs on some or all of these products. And then you move forward to actually setting up institutions which are actually going to be in charge of intra-African trade as a whole. So those are the strategies that they have put in place to actually ensure that this actually is realized.
Now, as an investment analyst, were you surprised that Nigeria pulled out at the time it did?
Well, yes and no. Yes, in the sense, in the respect that because of the fact that Nigeria was basically spearheading negotiations up until the last minute, our chief trade negotiator chaired the negotiating forum. Our Minister of Trade and Investments actually chaired the African Minister of Trade's conference too. So it was surprising because Nigeria had been in the forefront of negotiations, but then last minute we decided to pull back from the agreement. But however, and then on a no, because there have been concerns that have been raised about the effects, the short and long-term effects this is actually going to have on the Nigerian economy. So I think it took them to the last minute to actually decide or realize that we actually need to go back and consult more stakeholders to determine the best way for Nigeria in this deal.
Well, aside from consultation that perhaps a lot of people argued that we're not there, the issue of competition was also raised. And some people were like, Nigeria is not competitive. Okay, for instance, you have Rwanda, for instance, has its own airline, Air Rwanda. You have South Africa with its South African airline, but Nigeria, we don't even have our own airline. So if South Africa would have to bring in their products, the Apple, into Nigeria in their own airline, what about Nigeria? Are you going to transport your banana, for instance, to these countries in their own airline?
True. Here is the thing. So the issue of competition, although if left unchecked, competition could actually be detrimental to local manufacturing. But then again, it's all a good thing because it gets to spur businesses to actually want to up their game, if I should say. So now you know that you're no longer dealing with a local market. Companies are going to be forced to actually now they would have to start specializing. Competition is actually going to lead to increased specialization in manufacturing or products, and as such, them now knowing, oh, we have access to a broader market, they don't have any other choice than to be on top of their game. And concerning the fact that we're not there yet when it comes to having some not basic, but some infrastructure on ground, like you mentioned, the airlines and all, it's boosting, having an intra-African trade is actually going to boost the Nigerian economy in such a way that we would now be forced to start looking inwards, so for products that we would naturally want to get from China and then import into Nigeria to meet our local needs, we would want to start producing those goods and services over here because now we have access to a broader African market. So in the long term, the competition is going to be very healthy. Companies are actually going to start looking at specialization. We're going to see a whole lot more proper resource allocation because now you're not only dealing with your next door competitor in the next state. You're fighting for a market share with over 1,000 companies across the African continent, so you would be forced to look inwards and do your business better.
Now, the fact that it's not just that Nigeria did not sign this agreement, but the president was not at that AU summit. Was that a right, in terms of investment, really, was that a wise decision to do?
Well, I can't really speak to right or wrong, but I would say that the president made a decision based on the available information he had, and obviously from advice from his economic team. So his absence from it has been described by a lot of people as, being improper or he should have attended. But at the same time, it was his call to make. And I think he made that call based on the available information he had. So we would just, and then it's also a good thing that they stated that they are looking for a broader consultation, from manufacturers and labor unions alike. So it's a good thing that they want to increase their consultation and, really know what this trickles down to in the Nigerian market before going ahead to sign the agreement.
So, okay, talk to us about the possible gains from participating, in such Agreement.
Okay. So what does Nigeria stand to gain, and what does Africa stand to gain? Africa stands to gain a growth of a tremendous growth in our GDP. GDP is poised to grow by about 1%. Employment rate is going to grow by about 1.2% by 2022. And the United Nations did a scenario analysis. So let's say they did a pessimistic scenario analysis that there is a partial trade liberalization. So companies or products, there are going to be some exempt products. These products were term sensitive. So we're talking about specialized products that have intellectual property to them that is domiciled in a particular country. So imagine that these products are excluded. It's going to boost intra-African trade still by 24%. Which is huge if you're looking at where we are now. You know, it's poised to grow by about $35 billion by 2022. And then they went further to do an optimistic scenario that, oh, what's going to happen if there's a total liberalization, there is no trade tariff within African countries and the likes. And we saw that then there was even a further spike. We're going to have intra-African trade is actually going to grow by about 33%. By 2022, and compared to 60% where we are now, it's actually going to be a very huge leap for us. And then it's also going to boost, economic activities. Companies are actually going to be more specialized, like I said earlier. And all in all, I think there's more, we stand to gain more than we actually have to lose. So as a country, Nigeria in itself is actually, we have an advantage when it comes to trade with our neighboring African countries. So, yeah.
What about the local manufacturers and production?
Yeah, so that was one of the concerns that was raised by the president. And, you know, they said they are looking at the effects that having this free trade is actually going to have on local manufacturers. Then again, it speaks to the point of competitiveness, you know. So the trade, local manufacturing in Nigeria is not really going to be hampered, so to speak. I mean, if you look at it, Nigeria now, 38% of all our exports for manufactured goods actually end up in Africa. And imagine we had a freer market to do this. Nigerian manufacturing is actually going to, our manufacturing figures are actually going to increase by exports to our neighboring African countries. So if you look at the upsides too, they are pretty much there. The downsides to it are there have been concerns about what happens if someone wants to move his factory from Guinea-Bissau down to Nigeria. Then again, it still boils down to the individual countries, because as much as we are going to be adopting a single tariff, there are also going to be provisions for companies to actually guide what happens in their own individual economies. So.
Okay, Valiance, just before I let you go, how would governments and corporates respond to changes, you know, associated with all of this?
Okay, so in the short term, while there's that transition from moving to a free trade area, there are some costs that they have been termed adjustment costs. So these are some costs that government is actually going to incur, and is broken down into for public and private sector. So for the private sector, you're looking at costs such as your capital, your labor. Would you have to pay more money to train your staff to be able to meet up with the growing demand? Would you have to spend more money on trainings and the likes? And then you look at your capital too. Would your capital also have to? Would your capital structure need to change for you to meet those demands? So, and then you move down to the public sector for the governments and all. How much revenue cuts are they going to take from tariffs?
All right.
So,
thank you very much, Valiance, for your time. Valiance Moweta is one of the analysts at Afrinvest Securities. We'll take a break, and when we come back, we'll look at equity markets pre-open analysis. To stay with us.